While most investors were distracted by rate headlines, equity volatility, and another round of central bank rhetoric, something far more structural shifted in the background. It didn't ring a bell. It didn't gap a chart. It didn't make front page news. But inside the silver market, a boundary that had held for decades began to fail. The core event can be summarized in one sentence. The paper silver market, futures, swaps, and unallocated claims, has begun to decouple from the availability and flow of physical metal. That sounds abstract, so let's ground it. For most of modern financial history, the price of silver has been discovered primarily in derivatives markets. Futures contracts on exchanges like COMEX set a reference price that then propagates into wholesale bars, industrial contracts, coins, and retail products. The assumption embedded in that structure is simple. Paper claims are ultimately anchored to real metal. Not every contract is settled with delivery, but the option of delivery keeps the system honest. What changed is not that people suddenly want silver. Demand has always been cyclical. What changed is that the balance between claims and available metal has tightened to the point where that assumption is no longer operationally safe. This is the part most people miss. Markets don't break when something becomes expensive. They break when something becomes unavailable. Crowds watch prices. Institutions watch inventories, delivery queues, lease rates, and financing spreads. Over the last several quarters, those internal indicators have been sending a different message than the headline chart. Registered exchange inventories have trended lower in waves. Lease rates in wholesale markets have intermittently spiked. Fabricators and refiners have extended delivery timelines. Premiums in certain physical channels have diverged from futures references by double-digit percentages. None of this looks dramatic in isolation. Together, it signals stress in the linkage between paper and physical. The forcing mechanism behind this shift is structural, not speculative. Industrial demand for silver has been rising due to electrification, solar deployment, and electronics density. Estimates vary by source, but photovoltaic usage alone has grown from roughly 80 to 90 million ounces per year a decade ago to a range often cited between 140 160 million ounces today. At the same time, mine supply growth has been flat to marginal. Global production oscillates around 850 million ounces annually, with little spare capacity. Overlay that with a financial system that expanded paper claims during years of low rates and high leverage. Open interest in futures, unallocated bullion accounts, and structured exposure represents multiples of annual mine supply. That is normal until physical buffers thin. The crowd is missing this because it does not look like a crash. There is no single time-stamped event. Instead, the system shifts from abundant optionality to conditional delivery. The difference only matters when someone actually needs metal. And now, more participants do. Refiners need feedstock. Manufacturers need continuity. Sovereign buyers want bars, not contracts. Even funds that once rolled paper exposure indefinitely are beginning to test conversion pathways. Each of those behaviors pulls on the same limited pool. What's at stake is not just the price of silver. It is whether a reference market built on leverage can continue to represent a commodity whose marginal unit is constrained by geology, energy, and logistics. If that linkage weakens, downstream effects reach inflation metrics, industrial planning, hedging strategies, and confidence in price discovery itself. This analysis is educational only and not financial advice. Markets involve risk, including loss of capital. All figures cited are estimates or scenario ranges, and conditions can change rapidly. Consult qualified professionals before making any financial decisions. To understand why a paper-physical split matters, you have to understand what paper-silver actually is. In practice, most exposure to silver is not ownership of metal. It is a claim on price movement through futures, forwards, swaps, ETFs, or unallocated bullion accounts. These instruments are efficient. They allow hedging, speculation, and financing without moving heavy bars across borders. The entire structure assumes that, if needed, claims can be converted into metal at scale. That assumption rests on two stabilizers. First, most participants do not ask for delivery. Futures are rolled. ETF shares are created and redeemed in kind by a small set of authorized participants. Unallocated accounts are treated like cash balances. The system works because flows net out. Second, there is always some metal in the background. Exchanges maintain registered inventories for delivery. Vault networks hold eligible bars. Banks and dealers lease metal from central or sovereign pools. Even if only 1 to 2% of open interest ever stands for delivery, that small fraction is enough to anchor the entire curve, as long as it can be met. The mechanism breaks when three conditions align. The stock of readily deliverable metal falls. The flow of new metal becomes inelastic. A larger than normal share of claims seeks conversion. Silver is particularly sensitive to this because it is both monetary and industrial. Gold can sit in vaults for decades. Silver is consumed. Once it is embedded in solar cells, medical equipment, or electronics, recovery is slow and costly. That means above-ground free float is smaller than headline inventory numbers suggest. Consider a simplified numerical frame. Global mine supply is roughly 850 million ounces per year, range estimate. Industrial demand is commonly estimated between 600 million ounces. Jewelry, silverware, and investment bars, coins add another 300 million. In many recent years, total demand has met or exceeded supply, with deficits filled by recycling and inventory drawdowns. Now layer in derivatives. At various points, COMEX silver open interest alone has represented 900 million ounces notionally, roughly a full year of global mine output. That is not inherently dangerous because only a small fraction is ever delivered. Historically, 1 to 3% of contracts stand. If 2% of 800 million is demanded, that is 16 million ounces. Exchanges can manage that with vault stocks measured in the tens of millions. But the margin of safety is the difference between deliverable stocks and likely delivery demand. If registered inventory falls from, say, 80 million ounces to 40 million, while the number of participants who need metal rises, the ratio changes. Suddenly, 2% is no longer trivial. It becomes binding. Now here's where it breaks. When metal is abundant, the futures curve behaves normally. Nearby contracts trade close to spot. Lease rates stay low, often below 1 to 2% annualized. Backwardation, near-term price higher than later months, is rare and shallow. Arbitrageurs can buy metal, sell futures, and lock and carry. When metal tightens, 3 signals emerge. Lease rates spike. Borrowing silver for weeks or months becomes expensive. Nearby futures strengthen relative to deferred months. Physical premiums diverge from paper references. At that point, arbitrage stops working. The trader who would normally buy bars and sell futures cannot source bars. The dealer who would normally redeem ETF shares cannot assemble good delivery lots in time. The bridge between paper and physical narrows. This does not require panic. It only requires enough participants to treat paper as conditional. Now here's the structural asymmetry. Paper claims can expand instantly. Physical supply cannot. A futures contract can be created in milliseconds. A mine takes 5 to 10 years to develop. Refining and shipping take weeks. Recycling responds to price, but with lag. So the system is stable only as long as confidence in convertibility remains high. Once participants believe that delivery may be delayed, rationed, or repriced, they behave differently. Some preemptively seek metal. Others demand higher premiums. Market makers widen spreads. Banks reduce unallocated balances. Each action is rational. Collectively, they accelerate the decoupling. This is not a story about manipulation or conspiracy. It is about leverage meeting inelastic supply. The futures market was designed to manage price risk. It was not designed to absorb a structural shift in the physical availability of the underlying asset. When that shift happens, the derivative layer can no longer compress reality into a single number, and that is why a paper price can continue to trade while the real-world market begins to speak a different language. Every market stress eventually becomes personal. Structures fail only when the people and institutions inside them are forced to act. In a paper-physical divergence, the pressure does not hit the market all at once. It concentrates on a specific set of actors whose business models assume frictionless convertibility. The first group under strain is the market-making layer. Bullion banks, clearing members, and large dealers who intermediate between futures, ETFs, and physical flows. Their role is to smooth imbalances. When a fund wants exposure, they create paper. When an industrial buyer wants metal, they source bars. In normal conditions, those flows net. In stressed conditions, they don't. These entities are structurally short optionality. They promise that paper can become metal on demand. That promise is not a legal guarantee in every instrument, but it is a commercial expectation. Once that expectation weakens, their risk profile changes. They face a binary choice. Either continue offering liquidity at tight spreads and risk being the party that cannot deliver, or widen spreads, ration access, and preserve balance sheet integrity. That choice is not ideological. It is mechanical. Banks operate under capital rules. Inventory held on balance sheet consumes risk-weighted assets. A 20-30 million ounce silver position at $25 per ounce is a $750 million exposure. At 35, it is over $1 billion. Even before price moves, volatility raises margin and capital costs. The second group under pressure is industrial users, solar manufacturers, electronics firms, medical equipment producers. These actors are not speculators. They do not care about charts. They care about continuity. A factory that cannot secure input material on time does not slow down gracefully. It stops. Industrial buyers hedge using futures precisely because they assume convergence. They lock in price on paper and expect to lift metal when needed. If delivery windows extend from days to weeks or premiums rise 10-20% above reference, the hedge fails in its real purpose, guaranteeing supply. That creates another binary. Either accept higher effective costs and potential delays, or bypass paper channels and secure long-term physical contracts directly with refiners and miners. When that happens, volume migrates away from the visible exchange system. It does not show up as a price spike immediately. It shows up as less metal available to back the paper market. The third group is leveraged funds that are short volatility or structurally short the commodity through spread trades. Many relative value strategies assume that contango, backwardation, and basis relationships remain within historical bounds. They sell nearby contracts and buy deferred ones. They arbitrage ETF pricing. They warehouse basis risk. These trades work as long as convergence is reliable. When convergence becomes conditional, margin requirements rise. A basis that historically moved plus to 1% may swing 5 to 10%. A fund that runs 10x leverage on a low volatility assumption suddenly faces margin calls. It must reduce exposure, not because it is wrong, but because the model no longer fits the regime. The final group is sovereign and quasi-sovereign buyers. Some central banks, state refiners, and strategic stockpilers are not price sensitive in the same way. They operate on multi-year horizons and geopolitical constraints. When they enter the physical market, they do not roll contracts. They take delivery and remove metal from circulation. Each of these groups is constrained by something different. Banks by capital and liquidity rules, manufacturers by production schedules, funds by margin and volatility limits, sovereigns by strategic mandates. None of them can simply wait for the market to normalize if the underlying condition is physical scarcity. History offers a parallel in the 1960s London gold pool. Major governments attempted to cap gold at $35 per ounce by supplying metal into the market. On paper, the price held. In reality, physical demand from Europe drained reserves. For several years, the system appeared stable. Then, in March 1968, it snapped. The pool collapsed, and a two-tier market emerged, an official price and a free market price. The similarity is not that silver will follow gold's path exactly. The similarity is structural, a leveraged price discovery system confronted by inelastic physical demand. The difference is scale and speed. Today's markets operate in milliseconds. ETFs and futures embed leverage far beyond what existed in the 1960s. Information moves instantly, but metal does not. So the trap is this. Either the paper market contracts through reduced open interest, wider spreads, and higher margins, or the physical market must supply metal it does not have. One of those two has to give. This is where regime shifts begin, not with a headline, but with a series of rational decisions by constrained actors who all choose safety over smoothness. And when that happens, the market no longer fails symmetrically. It fails at its weakest conversion point. The reason this divergence is real is not sentiment, it is arithmetic. Silver is governed by three hard constraints: geology, energy, and time. You cannot print ounces. You cannot accelerate a mine beyond physical limits. You cannot refine, ship, and fabricate metal instantly. Every derivative claim ultimately maps back to those constraints, whether the market acknowledges it or not. Start with the broad balance. Global mine production has oscillated in a relatively narrow band for more than a decade, roughly 780 to 860 million ounces per year by most industry estimates. Even optimistic projections rarely show sustained growth above low single digits. Silver is often a byproduct of copper, lead, and zinc mining, which means its supply responds more to base metal economics than to its own price. Demand, by contrast, is structurally rising on the industrial side. Photovoltaic applications alone are now commonly estimated in a range of 140 to 160 million ounces annually, up from roughly 80-90 million 10 years ago. Electronics, medical uses, brazing alloys, and electric vehicles add another 250 to 300 million ounces. Jewelry and silverware contribute 180 to 220 million. Investment demand, bars, coins, and ETFs, varies widely by year, from under 100 million to well over 250 million. That means the system regularly operates near balance or in deficit. In several recent years, aggregate demand has been estimated to exceed supply by 150 million ounces, with the gap filled by recycling and inventory drawdowns. Recycling is price-sensitive but slow. A smartphone discarded today may not yield silver back into the market for years. Industrial scrap is more responsive, but even there, capacity is finite. Now layer in inventories. Exchange-visible stocks are not the whole market, but they are the marginal buffer. When registered inventories on major exchanges drift from, for example, 70-80 million ounces toward 30-40 million, the system's tolerance for delivery collapses. At that point, a single quarter of elevated demand can consume a material fraction of what is immediately available. Consider three simplified scenarios. Scenario A, stable flow, mine supply, 830 million Oz, industrial plus fabrication demand, 750 million Oz, investment demand, 80 million Oz, net balance, roughly flat. In this world, inventories oscillate but do not trend. Paper claims remain credible because physical buffers replenish. Scenario B, moderate deficit, mine supply, 820 million Oz, industrial plus fabrication, 780 million Oz investment demand, 120 million Oz, net deficit, $80 million Oz. This deficit must be met by recycling or inventory drawdowns. Over 2 years, that is 160 million ounces, more than the total registered stock on many exchanges. Scenario C, structural stress, mine supply, 800 million Oz, industrial plus fabrication, 800 million Oz, investment demand, 150, 200 million Oz, net deficit, 150, 200 million Oz. In this case, the system cannot clear through normal channels. Physical becomes rationed, premiums rise, delivery times extend. Paper price remains a reference, but no longer a clearing mechanism. None of these scenarios require a speculative frenzy. They only require continuation of existing industrial trends and periodic investment interest. Now bring in the derivative layer. Open interest across major silver futures markets has at times represented 600-900 million ounces notionally. Add ETF holdings, often 700-900 million ounces globally, and unallocated bank balances that are opaque but significant. The system functions because only a small fraction of those claims ever request metal. But the coverage ratio matters. If deliverable stocks are 50 million ounces and likely delivery demand is 10 million, the ratio is 5.1. If stocks fall to 30 million and likely demand rises to 15 to 20 million, the ratio compresses to 2.1 or worse. At that point, any incremental stress forces behavioral change. Banks respond by reducing unallocated exposure. Exchanges respond by raising margins. Dealers respond by widening spreads. Industrial users respond by pre-buying and bypassing intermediaries. Each response is rational. Each reduces effective supply to the paper market. This is why normal expectations fail here. In most assets, higher prices attract supply. In silver, higher prices may not generate metal quickly enough. The elasticity is low. A mine that is not already producing cannot respond within a quarter or even a year. So the system does not equilibrate smoothly. It adjusts through structure rather than price first. That is the hidden message in the data. The stress is not visible in a single number. It is visible in ratios: claims to ounces, flows to stocks, time to delivery relative to contract duration. When those ratios cross certain thresholds, a derivative market stops being a proxy and becomes a separate layer. That is what decoupling actually means. Not that paper trades, but that it trades without clearing the real-world constraint beneath it. When a commodity market begins to split between paper reference and physical reality, the reaction rarely looks like a clean breakout. It looks disjointed. Prices stall while premiums rise. Volatility spikes without trend. Correlations break. Observers call it confusing or manipulated. In reality, the market is doing exactly what its structure forces it to do. The first transmission channel is liquidity. Market makers quote tight spreads only when they can hedge. In silver, that hedge is the ability to move between futures, ETFs, and bars. When that bridge narrows, spreads widen. A bid that was once 0.02 wide becomes $0. Options implied volatility lifts, even if spot does not. Near-dated contracts become jumpy relative to deferred months. This is not fear. It is inventory risk being repriced. The second channel is basis behavior. Normally, the difference between spot and futures reflects storage, financing, and convenience yield. When metal tightens, the convenience yield rises. Nearby contracts trade firmer. The curve flattens or inverts. Backwardation appears not as a macro signal, but as a micro one. Metal now is worth more than a promise later. Arbitrage capital then retreats. The trader who once bought bars and sold futures to lock in 2% annualized carry now faces 6 to 8% lease rates and uncertain delivery. The trade no longer clears. With fewer arbitrageurs, small imbalances persist. Volatility increases. The third channel is forced positioning. Funds that rely on stability. Trend-neutral strategies, carry trades, volatility sellers experience regime mismatch. A basis that historically moved within plus 0.5% swings 3 to 5%. Margin models update. Clearing members demand more collateral. Leverage compresses. This produces selling that looks irrational. Futures fall on days when physical demand is strong. It is not a view on silver. It is balance sheet math. At the same time, a parallel market forms. Retail and wholesale physical channels begin to quote independently. Premiums of 5 to 15% over futures become normal in certain products. Delivery windows extend from in-stock to 2 to 6 weeks. Large buyers negotiate off-screen. So you get a paradox. Paper price appears contained. Physical access becomes scarce. Observers misinterpret this as suppression or distortion. The reality is simpler. Two markets are now clearing different constraints. The derivative market clears financial risk. The physical market clears material scarcity. Feedback loops then emerge. Higher premiums encourage pre-buying. Pre-buying reduces visible inventory. Lower inventory raises perceived risk. Higher perceived risk widens spreads and margins. Wider spreads reduce liquidity. Lower liquidity increases volatility. None of this requires a headline. It compounds quietly. Historically, when this pattern has matured in other commodities, oil in 2007-2008, natural gas and regional shortages, base metals during supply shocks, the eventual repricing is discontinuous, not a smooth trend, but gaps and air pockets. That is because once enough participants stop trusting convergence, behavior flips. Instead of sell strength, buy weakness, it becomes secure access, reduce exposure. The objective shifts from return to continuity. Watch for these signals. Persistent backwardation in nearby silver contracts, rising lease rates above historical norms, e.g., sustained moves from 1 to 2% toward 5 to 10% annualized in certain tenors. Exchange inventories declining despite flat prices. ETF creation redemption activity becoming one-directional. Physical premiums staying elevated even during futures pullbacks. Options skew pricing more upside risk than downside. When these coexist, the market is telling you that the price is no longer the only clearing mechanism. This is why reactions often look wrong. A day when futures drop 3% while wholesalers raise quotes is not a contradiction. It is a bifurcation. One layer is responding to margin and liquidity. The other is responding to scarcity. Over time, one of two things resolves that tension. Either physical supply expands materially, restoring confidence in conversion, or the derivative layer contracts, forcing price discovery closer to reality. Until then, the market trades in two languages at once, and that is when small shocks become non-linear. Because in a thinly arbitrage system, a modest shift in behavior can produce outsized moves, not because silver is special, but because leverage always magnifies constraint. The mistake is to wait for a single event. Regime shifts in commodities rarely announce themselves. They reveal themselves through the way markets stop behaving the way textbooks say they should. When structural stress builds in a commodity system, the timeline is not measured in decades. It unfolds in layers, days, weeks, quarters. The shift from price-led to availability-led markets does not happen in a single print. It happens as behavior changes before consensus does. The next 24 hours in such a regime are rarely dramatic. You see microsignals. Spreads widen slightly. A nearby contract trades firmer than expected. A dealer adjusts delivery language. A clearing firm raises margin by a few percentage points. None of these appear decisive. They are the tectonic plates moving. Over the next week, those microsignals compound. Liquidity thins in off hours. Volatility becomes asymmetric. Small moves up feel sharper than equivalent moves down. Physical premiums stop compressing on pullbacks. Commentators begin to say the market feels different, even though the chart looks ordinary. Over the next month to quarter, the system is forced to choose a path. There are three broad scenarios. 1. Base case. Slow repricing through structure. This is the most likely outcome in a non-crisis environment. Paper markets remain functional, but with degraded efficiency. Open interest gradually contracts. Margins remain elevated. Arbitrage capital stays cautious. Physical premiums persist in a 5-15% range depending on product and region. Inventories drift lower in waves rather than collapsing. Price discovery still happens on exchanges, but it becomes more volatile and less predictive of real-world cost. Silver trades in broader ranges, perhaps $22 to $30 instead of $23, $26. Not because of speculation, but because liquidity has thinned. Indicators to watch: exchange inventories trending lower over multiple months despite flat prices. Lease rates elevated relative to pre-2020 norms. Backwardation appearing intermittently in near contracts. ETF flows skewed toward net accumulation. Dealer premiums remaining sticky on dips. This is a regime shift without a headline. The market becomes structurally nervous. 2. Stress case, liquidity break, and nonlinear move. This path emerges if a catalyst concentrates demand, a surge in industrial procurement, a sovereign buyer stepping in, or a financial shock that drives investors toward tangible assets. In this scenario, a modest increase in delivery demand overwhelms thin buffers. A few million ounces suddenly matter. A contract month tightens. Spreads gap. Clearing members hike margins sharply, 20-40% in a short window. Funds reduce exposure mechanically. Futures drop even as physical tightens further. Then the paradox resolves violently. Either futures snap higher to re-anchor reality, or a two-tier market becomes visible. Paper silver and deliverable silver trade at meaningfully different effective prices. Indicators to watch: abrupt spikes in lease rates across multiple tenors, sudden drops in registered inventory within days. Exchange rule changes or emergency margin hikes, persistent backwardation across the front curve, reports of delivery delays, or rationing in wholesale channels. This is not a smooth bull market. It is a liquidity event. 3. Relief case, supply response, and structural repair. This path requires something real to change. Either a surge in scrap recovery, a release of strategic stock, or a coordinated effort by large holders to reliquify the physical market. In this scenario, inventories stabilize, lease rates normalize, arbitrage returns, premiums compress, the paper-physical link regains credibility, but this is the hardest path. Mines cannot ramp in quarters. Recycling responds slowly. Strategic releases are politically constrained. Relief is possible, but it requires intentional action, not market wishful thinking. Indicators to watch: sustained increase in exchange inventories, lease rates returning toward historical lows, compression of physical premiums across regions, expansion in open interest without volatility, public confirmation of new supply sources. Without those, relief is cosmetic. The larger takeaway is this: markets are not just charts, they are logistic systems layered with leverage. When the physical layer tightens, the financial layer adapts. If it cannot adapt smoothly, it adapts discontinuously. Silver is simply revealing that truth. A price discovered in a leveraged environment only works as long as conversion remains credible. Once that credibility weakens, behavior changes before consensus does. Hedging becomes hoarding. Liquidity becomes optional. Optionality becomes expensive. That is not a crisis by default. It is a regime change. In a world where electrification, energy transition, and geopolitical fragmentation increase demand for tangible inputs, more markets will face this dynamic. Silver is early because it sits at the intersection of industry and money,